Welcome, everyone. This is a Mastermind Book Club. We're here today with some of our members getting ready to review the second part of the most important book that we've been going over, Tax-Free Wealth. Tax-Free Wealth is a book in the Robert Kiyosaki series. I don't remember exactly what the title said, but it's one of those books that helps you with being tax-free as much as possible and creating wealth. Very important book to know about, to be able to read about. So here we are with the group, and we're going to get ready to give you a brief summary, as brief as possible, so that you can take away with our second part of this review some of the things that we've all learned here. So I just wanted to start out with any one of you that's ready to give this a brief summary of one of the things that you learned in this book. Does anyone want to get started?
I'll give a go.
Go ahead, Charles.
First thing I learned is that with all tax matters, get you a professional that actually cares and knows exactly what they're doing. I've been a victim of this myself, trying to take shortcuts and save money using TurboTax or even what's the other favorite tax? Johnson Hewlett. What's the green one?
No, I thought it was Quicken.
Quicken. I've used all these different H&R Block.
Okay.
And I used to think that they were the best. But one thing the book says is that you find you a professional, even if they cost you more money for their service, that they will eventually save you that money in the long run. If they're a true professional and they truly care about you and care about what they're doing for you. Don't just hire anybody to assist you in your tax matters.
Very good. Very good.
He gave an example of the pickles. Like some people like pickles, but and some people don't. The people that don't like the pickles is because when you give them a pickle with their sandwich, the pickle juice gets all over the place. And if you don't like pickles like that, you don't want the juice going all over everywhere. Whereas people who like pickles, they really don't care about the pickle juice being all over the place because they love the flavor of pickles.
Awesome, Charles.
Knowledge is power in this area.
It's very good. Very good. Very good on the pickle juice. Thank you, Charles. It's
I got a lot more, but for the sake of the call,
give you
I'll keep it that short.
A chance on the second turn. Martha or Gina or Reg or Ty, do you want to say anything?
So Gina. I just when it comes to this book, it was you had to have a good team, and especially when you have a business, you have to have a tax advisor, investment advisor, legal counsel, a banker, and your strategies to be able to succeed in the business and to be able to succeed to get tax-free and be successful in whatever you want to do in life. And then so this book is about reduced taxes before and after. They're talking about deductions, the appreciation and the appreciation, trust tax credits, estate planner contribution, and choose the right business. So you have to make sure you follow your goals and choose the right thing to do and something you really love to do. Don't do it just for money because you're going to be suffer. Do it because you really like it, you really love it, and you want to enjoy it. Not only want to make money, at the same time you want to enjoy what you're doing. And that's the best thing when you want to choose your business. And for me, it was very good information. And they talking about the appreciation, increase the value of your property or your business, and the appreciation decrease the value over time. And whatever you want to do, buy a houses. They're talking about a lot of people doing like flip flop. They buy a house, they renovate the house, and then they sell it for some kind of money. That way, when you buy the house is going to be tax free because you invest a lot of money, and to reduce the whole house, make it pretty. And there's a lot of people in this kind of business because they work hard. They don't have to work too hard. They have to invest money, fix the house. They can live in the house less than 5 years without paying taxes, and then they can sell the house and do it the same thing over and over. That's way, and these people is going to make money, and then when they reduce the taxes, or can it be tax free? So it's a lot of ways to work with the way to try to be tax free. A lot of tricks and a lot of ways to work in different kind of business. Depends whatever you like it. Depends what you like to do.
Very good,
And,
very good, Martha. It says that you need to live in the house 2 years to be able to take the best advantages of the house, of the taxes, sorry. So thank you for that, Martha.
Oh,
Thank you for that.
2 years, not 5 years.
No, 2 years.
I was
2
thinking
years.
to say
Minimum
5
2
years.
Two out of the
I
last,
mean,
Yes.
two out of
two.
the last 5.
Reggie knows, and I think Charles knows. I think they're both into real estate. Yes.
oh,
Reggie,
okay.
what
Thank you.
what would you like to add now, since we've got your mic open here?
Oh, wasn't ready, but one thing I'll mention, which I didn't know, was investing in mutual funds. So there was
Oh,
a
yeah.
mention, if a mutual fund buys a specific stock, the mutual fund is just basically a basket of stocks, for those who aren't aware, a basket of stocks that are basically owned by a specific fund that they're trading this basket of stocks, and they buy these different stocks at different levels, and basically they comprise a fund, and you buy, like, and then the fund is priced accordingly across those stocks. There's a certain price point that they get, and you buy that mutual fund at the specific price point. But basically, so if the mutual fund has a specific stock, let's say they bought it like $10, and that was like three years ago, let's just say, and then you come into the fund here, and now that stock is at $50. If you now come in at 50, and even though that particular stock that's inside the basket of stocks that they own was bought at 10 and made $40 gain, you actually, even as a new person who's just new coming into the fund, you have to actually pay the tax. You're partly responsible for the taxes that are paid on that stock, which is like interesting. And then on the other hand, if that fund happens to then lose money overall for the year, you actually still have to pay taxes. So like that's one of the downfalls of a mutual fund, in that you actually are like you're not always gaining in the way that you think, even if the stock, like minus the point I said, where if the mutual fund goes down, you're not always gaining in the way that you think if you come in at certain times whereby there's certain investments that were already made that preceded you. You still are not benefiting to the way that to the extent that you may have wanted. Still have to pay taxes on those things. So it's kind of like weird. But that was one thing I'll just offer. I mean, there's many things, but I'll just start with that one. I wasn't aware of that with the mutual fund.
It's very true. Thank you, Reg. And also be aware that in order to be considered, to be able to write on your taxes that you're a trader or an investor, you have to be trading, according to the author, at least $100,000 a week, not 10,000, not less than that, $100,000 a week. So in order to be considered. So that's why my accountant keeps telling me that I'm not officially a trader, because I haven't been trading that amount at all. Not yet. It's coming. Ty, would you like to add anything quickly on here?
Starts, David, if I can.
Sorry?
I want to add one quick thing to what Reg was saying, real quick.
Good.
He mentioned a key point that I want to bring up about your 401 or your IRAs. You know, how you're putting in pre-tax money, and the thing of it is with the pre-tax money is that you're believing that your income is actually going to be less during the time of retirement. He said that's a totally wrong way of looking at it. You want to actually like start looking at your retirement, that you will be at even a higher tax bracket than you are now. And that when you know, those funds, he was saying you can, if you're getting 2 for 1 or something of that nature with a job, yes. But if you're just putting in these funds, thinking that, you know, you're going to be, you know, 60% less than your, or 40 to 60% less than your current salary, rethink that. I thought that was a key point in the book that he brought out. And I just wanted to mention that. I thought that was really crucial because we all have IRAs and 401ks if you work a
401k.
job.
Mhm.
Yes.
Awesome.
So I wanted
Well,
to just.
There's
to
one
put
other
that
catch
out.
onto that, Charles, is that most people don't know this. You didn't mention it. It wasn't mentioned in the book. Once you reach retirement age, there's a limit to the amount of money you can take out without getting taxed. So if you're with your spouse, you can take up to maximum about $20,000. And after that, everything gets taxed. People won't tell you this about IRAs or
Right.
Roth IRAs or anything of 401ks and so on. You're going to get taxed if you want more than the minimum amount. So just be aware of that. Ty, would you
Therefore,
like to
your
add
income
anything or
is
you're
less.
good? Yes. Thank you, Charles. Thank you.
Hey, hi everybody.
Hey,
Actually, I was listening to, and I didn't know that after you retired that you got taxed higher. So that was interesting to find out. And also, that the IRAs and everything are not a good thing to buy houses out of, because the company owns that, and that it's a bad, you know, like some people will say, oh yeah, you're saving your Roth IRAs and your IRA money towards a home. But according to what the tax advisor that was speaking was saying, he said that's a bad idea because the
Well-
company owns it.
well, Ty, it's a little bit tricky. So there's something called a 1031 exchange, and that allows you to utilize your IRA before retirement age and put it into a house or something else. There are a few other things that can be done with it. So, but you can, if you know how to utilize, if you have an expert that knows how to do a 1031 exchange, you can.
Yes, I think
he
that's the
said
one
that.
time
He
that you
did
can
say
take
that.
out money from your IRA and it not be
Yeah.
taxed against you right then and there. If you're using it to purchase a house or a down payment for a house, I believe you know that's the
I
only
didn't.
reason you can
That's
do
right.
that.
So,
But
yeah, Ty,
good to
I
know
hope that
about
that explains a little bit clearer. You can take out of the IRA, but it has to be done through a professional. I only know because I used to be licensed in insurance, and I know the game, although I haven't lived up to that license that I got. I just got it and moved on. Now,
Yeah.
I just wanted to give you this brief review in reference to this book. Number one is setting up an LLC is crucial to whatever business you're in because it allows you the most tax advantages. Number two, most things are tax deductible. The only thing is you have to find the right wording for it. For example, as Reggie and I were in this other group, and I told him that, or in the group, I said that if you buy a belt and you're looking to get a tax write-off, you're not going to get it. However, if you buy the Charles Peter Comer belt and you're going to this event to show it off and you sell it, great. But if you don't sell it, you can write it off as a loss. So you have ways to be able to claim this. You can write it off as a loss or you can write it off as an investment. It depends on how things go. There's always going to be a way to write off taxes. You've got to figure it out. It's just wording. That's the bottom line. So this is it for our review on this book. There's many other things that can be covered in this audio book, but the reality is that we're not going to get to everything in the book. We've got to be able to focus on a few things and either live up to them or expand on them, because this book can get you to be tax-free for the most part if you're willing to do the steps that it's talking about. If you're willing to invest in a CPA, like they mentioned many times, I believe it's called tax-free wealth accountants or CPA. If you look it up, you'll find the website. I mean, it's mentioned in the book a few times. So that's it from the Mastermind Book Club. This is CEO David Diaz signing off. Have a great evening.
David.